Hi, welcome to 5 Good Questions. I'm your host, Jake Taylor. Our guest today is Mebane Faber, co-founder and chief investment officer of Cambria Investment Management. Meb is the manager of Cambria's ETFs, separate accounts, and private investment funds. He's authored numerous white papers and 3 books, including Global Value, which we'll be speaking to him about today. Meb graduated from the University of Virginia with a double major in biology and engineering. Let's ask him 5 good questions. All right, welcome back to 5 Good Questions. My guest today is Mebane Faber. Meb, where are we talking to you today?
Los Angeles, Manhattan Beach, California.
Great, and we're going to be talking to you about your book, Global Value. And I'll just do a quick little show right here. I actually have the physical version, which I guess is not as common as everyone else who's read it on ebook.
Looks, this is like more of a magazine pamphlet style than anything. It's short, which is good news.
Yeah, it's real short. It's a nice read. All right, let's hop right into our first question. In your book, you're talking about how there's likely a bubble in declaring bubbles, which I thought was an interesting observation. I'd like to get what your definition of a bubble is, and then let's just start with that, and then we'll kind of add to it.
You can try to come up with statistical ways of describing a bubble. So something like a multi-standard deviation style event. The challenge with that, of course, is, how much history do you have? How representative is it? And to be a student of financial market history, you almost have to have a good sense of humor. My favorite investing book, Triumph of the Optimist, takes all of the equity markets going back to, say, 1900, for example, and shows really what can happen. And so you see things like in the US where you've had 90% declines and entire markets shutting down like they did in China and Russia. But even then, you can take a step back, 10,000-foot view, and say, look, what is a reasonable amount to pay for a market or stocks in general, and come up with a fundamental metric. And the challenge, also a trend follower, if you've read our other work, is that markets can always get more expensive and can always get cheaper. But in general, having that fundamental anchor can give you some objectivity of what a bubble might look like over time. And it's usually accompanied by other subjective measures, people getting interested that never are interested in investing, people talking about stocks that normally don't, a little euphoria and greed. And we give a lot of examples of this in the book, as well as another white paper we wrote called Learning to Love Investment Bubbles. So it's a mix of both. It's a mix of objectivity as well as subjectivity.
So everybody's heard of the dot-com bubble, internet bubble, and then the U.S. housing bubble. Do you have an example of a bubble that maybe is a little less followed or less known or understood?
Well, let me take a step back and give you an example of one way to think about it. And so we use a metric called 10-year PE ratios. It was originally PE ratio has been around for almost 100 years. Ben Graham talked about them in his books over 80 years ago. Robert Shiller started popularizing the topic in the 90s when he was talking about the 10-year cyclically adjusted price-earning ratio, or what people call CAPE ratio. And that's nothing more than 10-year average PE adjusting for inflation, so trying to compare apples to apples over time. The biggest thing about that metric is that you can take it back to the 1880s in the U.S. And so on average, there's an average valuation of around 16 and a half. Thing is, in the U.S., for perspective, it's hit a low of 5 before in the past. It's also hit the high in December 1999. So when you're talking about the bubble in the U.S., of 45. So there's great euphoria as well as depression. But when you're talking about bubbles historically, and one of the things we were the first to do, to my knowledge, was take this and apply it to all the countries in the world. And your listeners may or may not remember, depending on their age, but the biggest equity bubble we've ever seen, at least in the bigger economies, is certainly Japan in the late 80s. And Japan hit a CAPE value, the highest in our database, almost 100, right? So that's double our internet bubble that we had in the late 90s. And one of the reasons Japan has stagnated for the ensuing 2 decades is for that reason, is that, yes, demographics are bad and a lot of the zombie banks, et cetera, but the main reason the equities have really, really struggled is it was the biggest bubble there's ever been. And the irony is it actually finally got cheap within the past few years, but it took over 20 years to work off. So that's a classic bubble. We like to consider ourselves student of bubbles. I think Bitcoin in the past year had a lot of characteristics of bubbles that you've seen historically, but the Japan is certainly the granddaddy of them all.
Yeah, that's insane. 100 PE on compared to even makes our internet bubble look pretty weak. So, talking about the CAPE ratio and your use of it as a tool, why do you prefer it over other valuation metrics? Like, let's say, in that same vein of Tobin's Q or like market cap to GDP, which has purportedly been Warren Buffett's favorite macro metric. What is it about CAPE that you like so much?
The irony is we really don't prefer it. We use it because it's standard. We can find it for a lot of countries around the world. Some of the other ones, such as market cap to GDP or Tobin's Q, are problematic or difficult to find for a lot of countries. CAPE in general works great a lot across 45 countries we track in foreign, developed, and emerging. But in general, all the valuation indicators should roughly say the same thing. So if you look at these in the US, for example, 1-year PE, 10-year PE, price to book, price sales, cash flow, market cap, GDP, every single valuation metric says the same thing. It says US stocks are expensive. Now, some say that it's terrible, some say they're only mildly expensive. There's no metric I can find that say stocks are cheap. Now, the quant in me, and it's boring to say, but the levels we're at right now, which is around 27, which is high historically, means future returns for the next 10 years are around 3%. Now, that's not horrific. It's not negative. Take out inflation, it's around flat. And it's not a bubble. It's not even above 30 yet. Remember, we hit 45 in the late 90s, so it certainly can go higher. But it just means it's going to be a headwind, right? So, but that's the same thing that all these other metrics say. Buffett's favorite also says stocks are expensive. So that's the bad news. The good news is if you look at the rest of the world, valuations for foreign developed, foreign emerging are around 15, which is lower than historical. The spread actually between the U.S. and foreign on a CAPE basis is the highest it's ever been since the 80s. If you look at the other valuation metrics, it's high still. The U.S. is more expensive than almost everything. We actually track 10-year cyclically adjusted versions of price to dividends, price sales, price to book. Really doesn't matter which one you use. We like the long-term time horizon because it smooths out recessions and contractions as well as hugely optimistic markets as well as markets people are really bumming about.
Right. Now, with if you're an individual stock picker, like a lot of investors are, why should you care about what the CAPE ratio says? Like, what can it still be useful for you as an individual stock picker?
Yeah, I would say first step is care what valuation says. So it doesn't mean it have to be CAPE, although a good buddy of mine, Wes Gray, Professor Drexel, has written a paper that shows CAPE works just great in stocks as well. So within the U.S. stock market, sorting stocks based on long-term PE ratios works great. He actually found out that CAP-B, which is 10-year price to book, worked the best, but very similar. But really the first step is what I call anything other than market cap weighting. And market cap weighting, look, it was a great invention. It gives you access to the entire market, but it's a very basic momentum system, and people don't usually understand this. It's based on nothing more than price. It's essentially size, market cap, and all that's based on its price, right? Times shares outstanding. So market cap weighting ends up, so the S&P 500, for example, ends up overweighting expensive stocks during bubbles. So if you think back to the 90s, the Cisco's of the world, that's not really the case right now. Large caps, it's the entire market is more expensive, and small caps are actually the most expensive they've been relative to large cap for a very, very long time. So we definitely caution away from small cap. But market cap weighting in general can be very problematic. So just in the US, so if you do anything, you could weight by earnings, dividends, valuation, equal weighting. And almost all of these, what people now call smart beta techniques, will improve the returns over market cap weighting by about 2% a year. And the same thing applies to foreign stocks and the way the world is right now. You do anything, so right now, the US is half of world market cap, okay? Back in the US is only 20% of world GDP. If you look back in the 80s, Japan was half a world market cap. So you get the expensive markets get to be the biggest. So if you're a diehard indexer, first of all, this is a problem almost every investor probably listening to this podcast listens to is almost every speech we give, we poll the audience and say, how much do you have in US stocks? And it's around 70%. And that's home country bias, right?
Right.
So at the very most, you should only have half in US stocks if you follow market cap weighting. And if you care about valuation, US is one of the most expensive markets in the world. You really want to move even further away from that. And most of the accounts we use, 50% is the max we put in US stocks as a percentage of world stocks. And in many cases, it's only a third.
I think that makes a lot of sense. Transitioning there with talking about these foreign stocks, low oil prices, tension in Ukraine. It seems like Russian equities might be a potentially attractive. They're at least very cheap at the moment. I think one of the things that I personally struggle with investing in them is the rule of law, and will it be respected, and can I get comfortable enough? Is the valuation cheap enough to overcome my hesitancy there? Are there any countries that you follow that you just flat out won't invest in because maybe you don't even believe in the numbers that are coming out of it? So why would I? Even like the Cape could be great, but if the numbers are crap, then I shouldn't trust it.
Well, there's a couple points in your questions that we'll talk about, and the first is of what's our universe. So we look at all foreign, developed, and emerging market countries. That's about 45. And it's important, there's a great quote from Winston Churchill that says something like, no matter how beautiful the strategy is, occasionally you have to look at the results, right? And so this is what we did in the book. And by the way, if you're listening and you want a free book, email me. I'll send you a free copy. But historically, sorting on valuation and sorting on CAPE works great, okay? So that much we know. And half of that is that you're investing in the cheapest countries and rebalancing once a year. But the other half is that you're actually avoiding the expensive stuff, which is what a lot of people miss. All right. So being a value investor is not just buying the cheap cigar butts or whatever it may be. It's also avoiding the really expensive junk. Okay. And it's not always the case right now, where right, the U.S. is one of the cheapest markets in the world for much of the 80s. But now it's one of the most expensive. So it's hard to be agnostic, country agnostic. The next point. And it's funny, though, the geopolitical, the biggest difficulty with a strategy like this is that no matter what, you're investing where things are worst. So the worst geopolitical headlines, the worst economies, the worst stock markets, most of these markets have already declined by 50 to 80%, right? Which is why they're cheap. And most of the markets that have high valuations are usually hitting new highs or near all-time highs, like the U.S. is. So it's harder behaviorally to invest in the cheap countries, but that's just a value metric, a value difficulty. And so talking about Russia or a lot of these countries where the rule of law, a couple points. One, had you had me on this show a year ago, I would have said likely the same thing. And sorting on CAPE in 2014 did poorly. A lot of the countries that were cheap simply got cheaper. Russia and Greece, good examples. Some of them did fine. Israel had a great year. It worked great in 2013. But that's the thing. Any active strategy only outperforms about half the time. Second, when you think of rule of law, look, it's always easy to stand back in the U.S. and say, we have a much better system. But thinking about these other countries, a lot of the things that often we're critical about have happened elsewhere. And look, believe me, I am no Russian apologist. I don't have any skin. I don't have any, I care less about the geopolitics. I probably know less about it than anyone. But as an example, I remember, the big to do, and it was terrible, terrible event when Russia allegedly shot down the commercial jetliner, right? Terrible news, awful thing to do. But many students of history remember that the U.S. also did that years ago, right, over in the Middle East, and so shot down, I think, an Iranian commercial jet. So things like this, where you say, look, these things could never happen over here. Look at things like Enron, right, one of the largest companies in the U.S. Going to zero. So what you never want to do is you never want to pick just one country, right? You never want to say, you know what, I'm going to put all my money in Greece, and that's that. Same way you'd never put all your money in one stock in the U.S. So you want to diversify. We do it with our ETF. We manage. We invest in the top quarter of the cheapest countries. So it's roughly 11 countries around the world, which right now, of course, is mostly Europe, Eastern Europe, emerging Europe, Hungary, Czech, Greece, of course, but also Brazil and Russia. So you end up with a somewhat diversified portfolio, but you can never. That's one of the challenges with this portfolio is you end up, like Templeton said, you want to be investing where blood is in the streets, or where
maximum pessimism,
where things are the worst, right?
Yeah, that's a good segue for our fourth question about ETFs specifically, and it seems like they're really gaining ground in the last few years as an investment tool. Why do you think that they're so useful for investors?
We've managed various types of structures, and in general, structure agnostic, right? People, mutual funds have been around for a long time. We have 2 private funds. We do separate accounts. ETFs, in general, are a better mousetrap. The tax efficiency, the low cost, it's a much better structured product than a mutual fund is, for example. And so the average ETF fee, I think, is around 0.5, 0.6%. The average mutual fund is 1.25. So it's clocking in at half of the average mutual fund fee. And it's a great vehicle for people. The tradability is not something that we're, a huge proponent as a major advantage, right? We want people to be more investors than traders. So that's more of an advantage for the hedge funds of the world out there to be able to have liquid trading vehicles, but it's not a huge one for investors. But it's perfect for something like this, right? So if there's an individual investor who says, you know what, all right, I want to invest in the world where it's cheapest. How do I get exposure to these countries, Greece, Russia, Brazil, Hungary? And so it's a way to be able to wrap these all into one wrapper and say, hey, you can just go buy one ETF. It'll be tax efficient. It'll do the rebalancing for you. And it'll be a pretty relatively cheap cost. And so we just think it's a good structure. But that having been said, there's ETFs that charge way too much, just the same as there's mutual funds that are really cheap, like Vanguard. So you can't make a blanket statement saying ETFs are great. There's plenty of screwy, inverse, triple leveraged ones that people should stay away from. But in general, it's a better mousetrap.
So our question number 5, your book and several other books, they do a pretty good job of showing how terrible people are at making forecasts, especially about markets. And this time of year when everybody's making their 2015 predictions, it's kind of something it's almost a joke at this point. There's so many. You have that on one hand, and then on the other hand, you have that you're using the CAPE ratio almost as a predictor of what there's a there's a good chance that things are going to work out well by buying these cheap things. How do you reconcile those two kind of seeming contradictions of prediction versus?
Well, here's the way to think about it, and what we talk about in the book is we say, look, over time, if you're going to buy and hold equities, you're going to get a positive return over time, right? Very long time horizon you have to look at. In general, you'll make 5 or 6% real return on your money. Bonds, maybe 1%. T-bills, probably nothing. But can you just take a step back and say, does it make sense to talk to a retiree or an investor and say it makes just as much sense to invest in stocks in 1999 when they were trading at a PE of 45 as it does in the early 80s or other times when they're trading in single-digit PE ratios. And in general, that's a common sense thing where people would say, no, that actually, doesn't make a lot of sense. Does it make sense to be buying Japanese stocks almost 100 times in the 80s, right? So there's a difference between forecasting, saying something like stocks are going to go down 20% this year, and saying, you know what, it makes sense. The more these go up and the worse the valuation is, to have a statistical bet that we're going to reduce exposure and place bets elsewhere that works better. It's more of a headwind, tailwind sort of thing, making intelligent bets. Something, the same thing happens at the casino, right? Where you make bets that would be reasonable, and then there's the ones really stupid. If you go play craps and put all the money on the horn bet, you're going to lose money over time. But if you play the certain other bets, you're only going to lose a tiny bit. You'll still lose, of course, but so, the way of thinking is that we're not trying to predict exactly what the world's going to do. You never know, and that's why you want to build portfolios and have an understanding of history. A long-only equity portfolio could easily still go down 50%. Nothing. And the quote we use in the book is that so much of that is determined by behavioral, right? Just what people are willing to pay. So in the U.S., we say it's almost like a comedy, is that you have to mentally in your head have the ability to reconcile the fact that stocks could go up by 80% as well as decline from 80% from here. Both of those have happened in the past. If you look at, we're going from a value of 27 to 45 or 27 to 5, the only difference there is what people are willing to pay. So in general, you want to make as many of the smart bets as possible that put the odds in your favor, but it's always going to be an uncertain outcome. You never know what the future is going to hold. So try to build a portfolio that can be robust in any market environment.
I like the phrase I've heard before is good things happen to cheap assets.
Yeah.
All right, so that's our 5 questions, and we always wrap it up with a bonus question of a book recommendation.
Okay.
So what's a book that you've read that you got a ton of value out of it, or you feel that it's kind of underrepresented out there, like kind of a dark horse pick?
Well, I'll give you 2, and I was trying to look on your bookshelf to see if I see either of them. Like I mentioned earlier, my favorite, it's expensive. It's a coffee table sized book called Triumph of the Optimists. It's probably $100, but it looks at equities, bonds, bills, what's happened for the past 100 years. For the cheap, frugal value investors, you can go download Credit Suisse does a yearly update called the Global Investing Returns Yearbook or Investment Returns Yearbook. So if you look up at CSFB, Geary, GIRY, I would read all of the last 7 years. They're highly, highly recommended. And those are free. That's probably a great place to start. And as I mentioned, if you want a free book, I'm happy to send you one if you're listening.
Well, that's great. Meb, we appreciate your time.
Great to be here. Thanks.
Thank you.